Welcome to Module 23. We had just finished Module 22, which is the master budget and other budgeting considerations. Now we're going to be calculating some variances and thinking about, well, what happens if we do not meet our budgets, or we exceed our budgets, or we're short when it comes to our budgets? We're going to have either favorable or unfavorable variances that we need to account for and be aware of. So let's say we thought we were buying materials at 10 cents a pound. That's what we budgeted for. That's the standard cost we imputed. But the reality is the materials cost us 12 cents a pound. That's 2 cents a pound more. You're saying 2 cents a pound more, that's 20% more on the 10 cents. That doesn't sound real favorable. And you'd be right. That would be considered an unfavorable variance at 2 cents per pound. It could go the other way. That's on the material side. Let's look at the labor side. Let's say we were budgeting $24 an hour for labor. And we say, well, we've got a lot of newbies that are new folks out there. They're only making 22 bucks an hour on average. You're saying, great, we're making $2 an hour extra benefit, a favorable variance when it comes to our price that's associated with that. And then you realize that, well, maybe the price of $2 an hour less with new folks is going to yield them taking longer to accomplish whatever they were trying to do. So instead of taking 2 hours per unit, it was taking 2.25 hours per unit to actually produce. So now we have an unfavorable quantity variance. So we're going to be talking about price variances. We're going to be talking about quantity variances. We'll be discussing materials and labor. Both will have those kinds of variances. And then we'll talk about a variable overhead variance to go with that. So there's elements of the good, the bad that go with all of that. And that's what we're going to take a closer look at. But let's take a shortcut to the upfront analysis of what we're trying to do. And let's talk about who is responsible anyways. We talked about the top-down and bottom-up approaches to budgeting. But when we look at our budgets, we want to say, okay, are you able to impact where you are making decisions? So structural performance, we're going to talk about who can control what areas, units, and managers. We're going to compare the actual results with budgeted amounts and evaluate those folks that can control those. We have to emphasize activities along the value chain where value is added in the chain. And we also need to exclude costs that one cannot control. So if you're working on the line, or you're a manufacturing manager, you may not be able to control sales. You may be able to quote quality control that might affect sales indirectly, but you've got the marketing and sales folks that are responsible for getting sales out the door. You just can manage the expenses in your department, in your area. So we're going to take a closer look at the environment and analyze the functions and where they flow and where they fit. So you've got an organizational structure, and it could be divided, functionally based, product based, geographically based, the different services, or the different customer groups that you are servicing. And we're going to look at the various organizational levels when we're analyzing this. And there are 4 levels we need to take a look at. We have cost centers, revenue centers, profit centers, and investment centers. And let's think about the kind of folks that can control costs versus revenues versus profit versus investment. We talked about a production manager. So the factory floor, factory manager, usually they would be considered a cost center. They really don't have impact on the revenue side. So they're not making decisions on how many we can sell or the marketing implications. They're not responsible for the net profit of both the revenues and the expenses. They're not going to be involved in the pricing decisions on the selling price. And again, it's going to be only the expense side and the investment. They're not usually deciding, are we building a new plant? They might get involved in some new equipment and new machinery, but overall, the total investment, buying another business, going vertical integration or horizontal integration, those aren't decisions they'll be making. So the cost center is the lowest level, the least responsibility, but we want to assign the cost to that cost center manager so that they can be responsible for the costs. Then we go to the next level manager that oversees the revenues and the expense, the revenue side of things, and ultimately the expense side of things. So the revenue center is responsible for generating the revenue, and we want to make decisions and assign responsibilities to those that can't impact the revenue side of the house. Profit is both the revenues and the expenses. So the profitability decisions, we're going to be looking at a higher level manager typically. And the most responsibility or highest level is usually that investment center. And that's usually the C-suite, the folks that are making the big bucks to make the big decisions and to allocate resources and what they're doing and how they're doing it. So if we take a look at a cost center, again, managing costs is a responsibility, zero revenue responsibility. And we talk about the manufacturing plant, a testing department, other departments in the manufacturing side of the house. If we go look at a revenue center, it's a manager for the generation of sales revenue. And again, sometimes we can assign some controllable costs incurred in generating that revenue. There may be some marketing costs, there may be some public relations, or maybe some other aspects. But again, it's the revenue generation that they are responsible for. If we jump over to the profit center, we're looking at both sides of the house of revenues and costs, and somebody with ultimate responsibility for generating profit in the division, in the department to go with that. And then the most frequently a segment of a company such as product line, marketing territory, store, that's part of the profit center as well that goes with that. So you have a store manager that's responsible for profits. They're not responsible for opening new stores, but they are responsible for the profits in the store being serviced where they're located. Highest level, we said, had the most responsibility is a manager for the relationship between profits and the investment in assets. So you say, wait, what do we mean? Investment in assets. So does that mean we rent more space? Sure. Or we build out another building, or we acquire another business. So the level of controllable costs and revenues associated at that level is much higher. And the ultimate bottom line profit is at the investment center level. Yeah, we have the profit center, which is profit, but the investment center includes being able to invest in additional resources and outside things. We also have non-financial performance measures, and those are important. We keep emphasizing the numbers. We're looking at the bottom line, but we also need to indicate, well, there may be changes, there may be deviations, and there may be legitimate reasons, or there may be economic conditions, or there may be non-financial elements that we want to include and account for. Maybe there's a shortage of labor, or maybe there's an abundance of labor. And again, that's going to impact how we are able to serve who we're trying to serve and what we're trying to do. So this is part of the big picture of where we're trying to do the analysis as we go.